Hi, I'm Karl Eggerss, Senior Wealth Advisor and partner here at Covenant. And I'm with Justin Pawl, our Chief Investment Officer and also a partner at Covenant. And we're bringing you the third quarter economic outlook. And we put this out every quarter. We put a ton of work into it, especially Justin, to really bring you some slides and some things to really see where we are going in the next quarter as best as we can see, as far out as we can see. And of course, this year, we've got a big election coming up, and a lot of people are curious about not only the election, but also a lot of the money printing that's been going on, and will that lead to inflation? And so I think what we're going to show you today is really going to give you some good insight as to what we expect here at Covenant, and that really does drive our investment thesis and our portfolios for the remainder of the year. So we hope you enjoy this, and of course, we're always available for questions and comments after this that you can reply back to Covenant. So without further ado, Justin, why don't you run us through some of the slides you have, and we'll go from there.
Thank you, Karl. First and foremost, we want to wish everyone out there that you're safe and you're healthy, both you and your loved ones. I titled this presentation, A Bull Market in Uncertainty. And the reason for that is back in April of this year, Federal Reserve Chairman Jerome Powell said the only certainty in the economic outlook is uncertainty. And while that largely has not changed, at least the economy is no longer in a free fall. So let's take a look at the agenda. So first and foremost, I want to start with the pandemic. That is the single largest variable in determining where the economy and where capital markets are headed. Then we'll check in with where the economy is. We'll take a look at the labor market and inflation and talk about why we don't think we're going to see a full V-shaped recovery in the economy. And finally, we'll check in with the election. It's a big election this year, and there's going to be, and a lot of people have asked questions about that. So turning to the pandemic, this chart here shows the new daily cases across the United States. The orange line is the 7-day moving average to smooth out some of the timing differences between when various jurisdictions report. And as you can see, recently, the number of new daily cases has rolled over, which is really good news. But unfortunately, we're still way higher than we were back during the height of the lockdown. Now, the economy continues to reopen, albeit somewhat haltingly. We have fits and starts across the nation in terms of which economies are able to open and which communities are able to get back to life on a semi-normal basis. But the good news is that the number of deaths has gone way down. Even though the number of cases is higher, the number of deaths has come down. And as a result, we're able to continue to get back on our feet from an economic perspective and push things forward. The unfortunate part of this is we all know in our daily lives, we're not going to be able to get back to a fully normal operating economy until we've been able to develop some sort of vaccine and widely distribute it so that COVID is no longer hindering the economic activity. Across the world right now, there's more than 160 vaccine candidates that are currently undergoing some sort of testing. Much of it is preclinical, which is the large bar chart on the left. You see about 138 vaccine under development there, but 21 have moved to human testing stages. And of those 21, 7 are either in phase 2 or phase 3, meaning they're reaching the final stages of the testing before they will request FDA approval. It's worth noting here that these pharmaceutical companies aren't necessarily waiting for FDA approval in order to actually begin production on these drugs. Many of these companies are already ramping up production, and some, like Moderna, Pfizer, AstraZeneca, have already inked deals with the US government to purchase hundreds of millions of vaccine doses that can be distributed upon FDA approval. It's not that the distribution is going to happen all at once, but at least both the pharmaceutical companies and the government are taking steps necessary to rapidly deploy these vaccines when they're available. So our expectation is that by the end of Q1 2021, if not sooner, there should be at least 6 or 7 vaccines that are available for distribution both in the United States and potentially globally. Now, even the most effective vaccine can't undo the economic damage that's been wrought on the economy so far. So let's take a look at where we are from an economic perspective. So the 11-year-old economic record expansion that we had ended in February of this year. After falling more than 5% in the first quarter, we saw a nearly 33% decline in the second quarter. That decline is the big downward column, the big downward facing column that you see in this chart that looks so out of sorts. Now, on the one hand, the magnitude of the decline is absolutely shocking, especially when you see it on paper like this. But it shouldn't be all that surprising, and in fact isn't all that surprising, given that we essentially pulled the emergency brake on economic activity in March and April of this year. This chart provides some good perspective on how this recession measures up to previous recessions. On the horizontal axis is the chronology from 1910 up to the most recent 2020 timeframe. And then on the vertical axis is the number of years of the economic contraction. Now, the values shown here aren't annualized, so they'll look a little bit different than on the previous slide, but basically it's showing the peak to trough decline in output of gross domestic product. And what becomes immediately evident is that this is the worst recession since the Great Depression back in the 1930s. This recession is in fact 4 times worse so far than what we experienced back in 2009 and 2010 with the Great Financial Crisis. The good news is that this is also likely to be one of the shortest recessions in history, in that it's only expected to last for the first 2 quarters of this year, and we're already seeing signs of expansion. On this slide, some of that expansion becomes evident. This is the New York Fed Weekly Economic Index, and it measures 10 daily and weekly indicators of real economic activity. And it's updated twice a week, providing near real-time look at the economic activity taking place. The blue line is the actual index itself. The red line is an overlay of the 4-quarter average annualized real gross domestic product, meaning that the index is recorded and then later on this actual GDP data, which is calculated, is overlaid on this data. And what it shows is that the New York Fed Weekly Economic Index is actually a very good predictor of ultimate GDP growth. So let's zoom in and take a look at the last few months. The bottom of the chart here, where the blue line starts to turn up, is April of this year. And as you can see, the economy's continued to expand over the last several months. It hasn't been without setbacks, and we expect that there will continue to be setbacks as we go forward here. Reopening an economy is not an easy process, and as hard as shutting the economy was, it's even more difficult to reopen it. However, if we don't see many more setbacks through the rest of this quarter, we think we could see growth in the neighborhood of about 20% on an annualized basis. Now, the flip side of that is after declining nearly 40% on an annualized basis coming into the third quarter, 20% growth only gets us about 20% or less than to the pre-pandemic levels. And there's really no other sector that illustrates this better than the labor market. So on this chart, what we're showing here is the number of jobs added since 2016. In other words, in the 4 years prior to the pandemic, we added 10 million jobs to the economy. And then over the course of 2 short months, we lost 23 million jobs. As the pandemic set in and the economic lockdown took hold, millions, tens of millions of people were laid off. Now, we've seen a nice bounce over the last several months where we're only down 3 million jobs from 2016 levels, but we're still down 3 million jobs from 2016 levels. Moreover, we're down 13 million jobs from just the beginning of this year. So on this next slide, we're showing a little bit different view of the labor market in terms of the overall unemployment rate. And when you look at this chart goes back to 2007, and the peak of the unemployment rate during the pandemic era, if you will, was about 14.7% recorded in April of 2020. That level's come down to 10.2%, which is a nice recovery. However, when you consider the level we're at right now, we're still above the highest levels of unemployment seen during the Great Financial Crisis. So we have a lot of labor supply that still is seeking jobs. Now, we also think that this chart can provide a decent template for what to expect going forward in terms of when will we get back to full employment levels. So back during the Great Financial Crisis, when the unemployment peaked at 10%, it took 5 years to get back to the pre-pandemic or the pre-financial crisis levels of just under 5%. And then it took another 5 years to get down to the record-setting 3.5% unemployment levels that we enjoyed so recently. So we think that going forward, that the pattern is likely to rhyme, and it's not going to exactly track it, but we think that we're at least 5 years away from being back at full employment levels. And the reason that's important is that our economy, it consists of basically 70% consumption, meaning households and individuals going out and consuming services, consuming goods, and without a healthy labor market, our economy is hobbled. So speaking of consumption, this slide is a reason for optimism. What we're showing here is total compensation in the U.S. in the blue line and compensation and transfer payments in the red line that's above it. Now, there's always a big spread between these lines because transfer payments are enormous and include big ticket items like Social Security, Medicare, and Medicaid payments. Now, if you focus on the blue line for a moment, prior to the pandemic, total compensation on a monthly basis was about $1 trillion, and it dropped during the lockdown by $100 billion to about $900 billion a month. But if you look above at the red line, you see that large spike. The rise in the red line reflects government stimulus in the form of the CARES Act that injected some $2.5 trillion into the economy. And so the height of the red line is larger than the drop in the blue line. So essentially, households earned or had income coming into their household that was higher during the lockdown than it was during the pre-pandemic level or during the lockdown. As a result, households ended up saving about $1.2 trillion during the lockdown. And why that's important is that represents future consumption potential, future potential economic growth. And as I mentioned before, since consumption is such a large portion of our overall economy, absent consumers' involvement in actively going out and purchasing goods and services, we're never going to grow very quickly at all.
So Justin, the question I get all the time is, with all the trillions and trillions of dollars being added, I mean, it's trillions, we're not talking billions, trillions of dollars by the Federal Reserve and the Treasury, and we hear all of these stimulus packages, which are probably responsible for a lot of the stock market boost. What does it do to inflation? Are our retirees that are watching right now, are they going to see their cost of living go way up like in the 1970s? That's probably the biggest question I get. And what does this mean for our kids and grandkids and so forth? So what about inflation? I mean, are we going to see real inflation come back anytime soon, in your opinion?
Yeah, I think there's a difference between real inflation and hyperinflation or really high inflation. You want to have some inflation in the economy.
Sure.
For a lot of different reasons. But let's talk about inflation and what we're seeing out there right now. So in July, people got up, the hair stood on end on their back of their necks because the CPI report came out pretty hot, if you will. The consumer price index was up 0.6% on a month-over-month basis. The core, which excludes food and energy, was actually also up 0.6%. Both were up twice about what the expectation levels were.
So that's a month on month, meaning if that continued, you'd see a really high inflation rate.
Yeah, that's exactly right. But when you look under the hood about what actually was moving during the last couple months, it turns out it was those items that had declined the most over the last 3 or 4 months. So for example, airfare was up 5.4% month over month. Well, but on a year over year basis, it's still down 23.7%. So,
yeah, there's a term on Wall Street called a dead cat bounce, which is a horrible term, but what it means is if you dropped a cat from a 10-story building, it's not going to bounce back up 10 floors, it may bounce up a floor or a few feet. And that's kind of what you're describing is we've seen a big dramatic drop in a lot of these economic indicators, and while they've bounced, and it seems like a big percentage bounce, they're still much lower than they were a year ago before the pandemic.
That's right. And so let me dive into some data to look at why we don't think runaway inflation is here, but contained inflation is certainly among us.
Sure.
So one reason for our contained inflation outlook is the declining velocity of money that we're seeing in the economy. The supply of money, which is illustrated on the blue line here, has exploded higher due to the actions taken by the Fed to maintain liquid credit markets, as well as the government stimulus programs that I mentioned before. However, inflation requires another component, and that's the turnover of money through transactions in the actual real economy. This is known as the velocity of money. And what you can see here in this chart is that the velocity of money has been declining for a very long time. Going back 94, 96, the late 90s, the velocity of money has been declining. Now it took a big leg down where you see that red line hooking downward, took a big leg down during the lockdown. And that leg down in the velocity of money is offsetting the supply of money. Even though we have more money circulating, there's fewer transactions and therefore no inflationary pressure. So another reason we don't believe that elevated inflation levels are a near-term concern is the output gap in the economy. Excess capacity, not only in the United States, but globally, it represents the difference between the potential output of an economy and the realized output of that economy. And with the lockdown that took place, there's a lot of spare capacity in the economy, as you can see in this chart here. This is showing the manufacturing capacity, specifically in the United States. And currently, the capacity utilization is at 65%. That's below the trough of what we saw during the financial crisis. We don't typically see inflationary pressures in the economy until that capacity utilization level is pushing through 80%. And if you look at the chart, you can see that rarely has the capacity utilization gotten to that level since the financial crisis, and we also haven't had any meaningful inflation since the financial crisis. So there's significant excess capacity in the economy. So to put a finer point on our inflation outlook, we see prices firming, we see contained inflation, we see that as a good thing. We don't want to see prices stay at the levels that they were during the worst of the lockdown, because we want to see companies survive, we want to see the economy thrive, and so some inflation is good. Now there are a couple of risks to our contained inflation outlook, and the first one is that if the global economy were to recover at a more robust pace than we're currently expecting, that would consume a lot of this spare capacity that I'm talking about, and we could see higher inflation levels than we're currently forecasting. The second risk to our contained inflation outlook would be that if the Fed began financing government spending. For example, if the Federal Reserve itself started sending $2,000 checks to every household, or the Federal Reserve began directly paying government expenses. That's what's known as modern monetary theory, or MMT, and that would cause inflation very, very quickly. However, that would require Congress to change the current laws, and so while we currently view it as a remote possibility, it is a risk that we need to acknowledge.
All right, Justin, the big elephant in the room is the election. People want to know not only how the economy may change with the election, but more importantly, how the stock market and the financial markets and their portfolios might change, and what things they should or shouldn't be doing prior to the election. So can you give us some thoughts or some key considerations?
Yeah, we're certainly getting inundated with questions about, should I change my portfolio if in advance of the election because I think so-and-so might win, or should I go to cash because I think this other person might win the election? And our simple advice is, in advance of an election, don't make big changes to your portfolio. The first reason is that in order to position your portfolio correctly for the aftermath of an election, you have to get two things right. Number one, you have to understand or predict correctly, really, who's going to actually win the election.
That's right.
And number two, you have to predict what the market's going to do relative to the winner of the election. So as we saw in 2016, Hillary Clinton had at least a comfortable lead in the polls, and most expected her to win. Moreover, most people thought that if she didn't win, Donald Trump would ruin the economy and ultimately the stock market would tank. Well, as we saw, 2016, Donald Trump took office. The market rallied almost immediately thereafter, and it really hasn't stopped since then as we're hitting new highs recently, although there's been more volatility. And so in advance of this election, we think that there's going to indeed be some increased volatility in the markets, but we encourage clients to stay disciplined. And I think this next slide will illustrate that.
So you mentioned the president, but we also have Congress, right? So
Correct.
you may get the president. So you have to get the president right. You have to get the reaction to the president right. But then we have Congress, and is it going to be split, or is it going to be a blue sweep? We have all those key considerations as well. So, and we know from the last time the polls were very inaccurate on all kinds of things. So I agree. I think the big heavy lifting for folks is to get their overall allocation correct in terms of how much risk do they want to take in the market or not based on their long-term financial goals. That does the heavy lifting for you. And then obviously you make some tactical changes. Probably the biggest work and the biggest changes and the biggest planning will come after the election once we know what's happened, because that could impact taxes and tax changes, and that's really where planning comes in. That's going to come from November 3rd to potentially December 31st.
Yeah, not only is whatever ultimate party wins, whether it's a Democratic sweep or you have some splitting of the Senate and the House and the presidency, could also determine what sectors outperform. And so
That's right.
the better way to spend your time now is planning contingency plans. If so-and-so wins and this happens, then this is how I'm going to position my portfolio. Otherwise, I'm going to position my portfolio this way. But again, making big changes in advance of an election or making political bets with your portfolio isn't a good idea. And I'll show you why in this next slide.
Sure.
So a colleague showed me this slide, and I thought it was pretty clever. What it shows is that if you only invested in the stock market during periods of time in which your favored party was in power, and that's demonstrated by the donkey and the elephant at the bottom of the slide here. Now that gray upward sloping line is if you were invested for the entirety since 1900, and obviously you would have outperformed greatly. So the investment lesson here is that you'll be far off voting in the election with a ballot and not with your portfolio.
So we've looked at a lot of numbers, a lot of charts, a lot of graphs. At the end of the day, really, what's the summary? What does this mean? Because really, this is a matter of the economy. We've seen a nice bounce, as we've said. President Trump's called it a super V. We would say it's not a V, but something that has bounced significantly, a lot more than people thought it would, and it's going in the right direction. But what does this mean for the next 3 to 6 months in kind of summary?
Yeah, and we see eye to eye on this, obviously, Karl. We've seen the beginning of a V-shaped recovery, but as I mentioned before, the fastest growth is likely behind us. And we expect the economy to continue to recover, but it's going to take an extended period of time and probably a lot longer than most people are giving credit for at this point in time. So with that, let's conclude with a summary of our views. We just lived through what will likely be one of the shortest but most intense recessions on record. Third quarter growth should be very strong as a reflexive bounce to the decline in the second quarter, but we don't expect that same pace of growth going forward. Demand destructions currently outweighing supply disruptions, and there's an enormous amount of excess capacity and available labor in the economy. It means that the recovery itself is going to take longer than many expect. Interest rates are going to be lower for longer, which means that traditional fixed income is going to play a smaller role in driving performance of portfolios going forward. The Federal Reserve and government took decisive action to stimulate the economy in the midst of the lockdown. It wasn't perfect, but speed was more valuable than precision at that time. And we're likely to see increasing volatility in the stock market over the next few months. It's important not to let the politics get in the way of how you manage your portfolio. And finally, COVID is a huge variable in the path of this recovery. If the vaccines are delayed or ineffective, the course of this recovery could take a dramatic turn for the worse. So stay disciplined.
All right, Justin, thank you very much for that. Appreciate it. I know you put in a lot of work into this, and we're going to do more videos in the future. This one was primarily focused on the economy and our outlook for the third quarter, and we'll be doing more videos on the stock market, financial planning tips, etc., on our YouTube channel. Justin, thank you very much.
My pleasure.